Welcome to Topic 1, Introduction to Accounting, Part 5. What we'll be covering in the Part 5 video includes identifying and describing the qualitative characteristics of our financial statements, and then we'll explain the limitations of the accounting information that is presented in these financial statements. So starting off with our qualitative characteristics, all of our reporting entities are required by the AASBs to prepare those financial statements with the following characteristics. So first of all, we have two fundamental qualitative characteristics. First one being relevance. So what we mean by relevance is the ability to be used to influence decisions. Also, it's affected by the concept of materiality. So something's material where if it's omission or misstatement could influence decision making. So in other words, if we leave it out or if we put it in there but it's wrong, so we misstate it, it could influence someone's decision maker's decision. So where that occurs, then we can say that it's material. And if something's material, that also makes it relevance as well. So relevance is the ability to influence a decision. And secondly, the second fundamental qualitative characteristic is faithful representation. So financial information is faithfully representing where it's complete, it's neutral, and it's free from error. So complete is in we've got everything in there, there's nothing missing, no gaps. It's neutral, so it's not biased. And then lastly, free from error, so there's no mistakes in it. Everything's correct. Okay. So next we have for enhancing qualitative characteristics. First one here is comparability. So comparability means that we've got some consistency in the measurement of the items in the financial statements and also the presentation of those items in the financial statements. So it's not different from one year to the next. So we've got consistency across years so that we can compare across years. And we also have consistency across firms as well. So if you're, say, considering to invest in a company, you can take two firms, say, in the same industry, they might be competitors with each other, and you can look at their information and you can compare it because of the consistency in measurement that's applied within those firms and also across those firms because they're following accounting standards and regulations. Next, we have verifiability. So here the information faithfully represents what it suggests that it is representing. So if I have a motor vehicle recorded on my balance sheet for $100,000, I need to have the documents to prove that that motor vehicle did in fact cost me $100,000. So I can verify that information. It's not fictitious, it's not guesswork. I've got proof. I can show, yes, this is what I'm saying that it is. Thirdly, timeliness. Information is available to all stakeholders in time for their decision-making purposes. So there's no point getting information to our decision makers 12 months after they wanted to make that decision. The information is not going to be relevant, it's not going to be useful, it's not going to be helpful to them either. So we want to get the information out in those financial statements in a relatively short period of time so that it's still relevant to them so that they can make well-informed decisions. And then lastly, we have understandability. So here we want clarity and readability of presentation. So it's got to be clear so that it can be understood, and also readability. So we want our users to be able to read it without any major problems. They can look at it and they can generally understand what's going on in the financial statements. So now looking to our limitations of accounting information. Even though there is some limitations in accounting information, it doesn't render the information useless. Okay, so I hope you're not sitting there thinking, well, why would I even look at this financial statement because, well, you're telling me it's got all these limitations now. Not the case. Yes, there's limitations, but as long as you're aware of the limitations when you're actually dealing with accounting information or reading a financial report, the reports can still be very useful to you. So first of all, we have a time lag in the distribution of information to our users. So generally your accounting period runs with financial year end in Australia, so that's 30th of June. The reports have to go through a process of audit, particularly for your big, large listed companies. So they go through an audit process before they're then released to the public, to the shareholders. And that generally takes around about 3 months to happen. So annual reports generally are not published until around about the 30th of September, thereabouts. So we've got around about 3 months time lag to get that information to our users. Also, financial accounting is based on historical information. So you could argue that it is actually outdated. So financial accounting, it is always looking behind itself. So it's looking into the past and it's presenting on the past. It's all based on past data. Okay, so again, just something to be aware of when you're looking at a financial report. Also, we have subjectivity. So there is subjectivity in some of the information that is presented within the reports. So there is a lot of choice that's given in what items are reported and also how to report them. So some information as well that's useful for decision making may not be disclosed either. And some of the reasons behind that can be because the cost of disclosing that information is prohibitive. In other words, it's too expensive. It's too expensive to collect it, get it together, and then present it in a meaningful manner. Or alternatively, they may not wish to disclose that information because it could provide their competitors with some sensitive information that's then going to strengthen their market position compared with our market position. So they may not want to make that information public. So how does subjectivity impact on decision making? So when we're using accounting information for decision making, just need to be aware of the degree of estimate and opinion in some of the items. Like I said, it doesn't render it useless. It's a case of just be aware that it may not be an actual figure, it could just be an estimation, and the actual figure could ultimately be different to that estimate. Also, understand the assumptions that are made behind certain transactions as well. Okay, certain accounting-based assumptions that are made, or maybe it's some assumptions in terms of a calculation that's been derived. So again, just understand the assumptions that are going on there. So what this means is that we could have a potentially different decision if a different assumption or a different estimate had been applied in that situation or to that item. Okay, but again, it doesn't render it useless. It's just be aware of it and use it in that context. So just to summarize topic 1 for you, the most important part of topic 1 is around the identification and the explanation of the elements of the income statement, of your balance sheet, and of your statement of changes in equity. So those 3 major statements. The process of accounting does concern identifying, measuring, and communicating economic information for decision making. So that's accounting in a nutshell, communication. Okay? Communicating financial information about a business so that it can be used for the purposes of decision making. Our users of accounting information can be both internal and they can be external to the firm. Management accounting. This one's related to the needs of the internal users, whereas our financial accounting is all about our external users. The main source of company regulation is our Corporations Act. We have our ASX listing rules, and there's also the influence of our accounting profession, so your chartered accountants and your CPAs. The limitations of accounting relate to our time lag, historical nature of the information, and also the costs associated with releasing financial information. All right, so that's summarising topic 1 for you. So hope you enjoy moving on to topic 2, topic 3, topic 4, through to 6 for the financial accounting component of this course.